Not confronting your income and expenses. Do you avoid confronting your money? Do you avoid checking your bank account just because you don't want to face the depleting balance in your account? According to the Organization for Economic Cooperation and Development, OECD, only about 1 in 3 adults worldwide have the knowledge and understanding of their finances to make informed financial decisions. That's why they often find themselves in sudden financial crises, not knowing how to pay for it. It's like inviting disaster, encompassing overspending, debt accumulation, and lifelong poverty. Not having an emergency stockpile. Have you ever faced an unexpected expense without any savings to fall back on? You are not alone. According to a survey by Bankrate, only around 41% of Americans would be able to cover an unexpected expense of $1,000 from savings. Cars break down every day and hospital emergencies come unannounced for everyone. But not everyone is lost. The far-sighted people set aside at least 6 months of living expenses for emergencies. When you get your paycheck, fill your tank up with gas, get the whole week's necessary groceries, and pay your health insurance premium. Not asking, do I need this? Do you also go to buy milk and veggies and end up buying those newly launched delicious but very expensive chocolate chip cookies? Grocery stores strategically place such impulse buy items near the cash register to lure shoppers into last-minute additions. A Slick Deal survey showed that an average American spends $4,500 annually on impulse buys, the things you absolutely don't need. So don't be lured. Instead, save and invest all that money so it actually comes to your rescue when you truly need it. Indulging in money-draining hobbies. Movies, TV shows, and social media all depict people going on expensive travels, skydiving, and eating out every day. And soon, we common folk start believing that that is how our lives should also be. We don't realize that it's all a myth, especially created to make us spend money on things we don't need. The average American household spends around $3,000 per year on entertainment, dining out, and travel. It makes other people rich literally at our expense. To avoid this, strike a balance. Don't splurge indiscriminately, set a budget for your hobbies, and prioritize activities or find affordable alternatives. Paying yourself last. Have you ever asked yourself, what are your biggest bills? Most people would say rent, electricity, and loan repayments. Most people don't think of their investment plans as a bill, but the rich do. Most of us save whatever is left over. That is, if you have $10,000 in income and $8,000 in expenses, you save $2,000. But that's not the way of the rich. Rich people first allocate their income towards their savings plans and then spend from whatever is left over. This is called paying yourself first. Your savings are also an obligation, like your rent, utilities, and subscriptions. Being cool with bad debt. Have you ever found yourself swiping your credit card for purchases you know you can't afford outright? It's a common scenario in today's consumer culture. The average credit card debt per household in the US is approximately $5,315. Whether it is for a meal at a restaurant, a movie date, or a new shiny gadget, we rarely hesitate to swipe the card. And it gets worse when you start swiping it for lifestyle upgrades that you can't afford. A sports car instead of a basic car to commute to work. We don't understand what's good debt and what's bad. And soon enough, we get too comfortable with bad debt, trapping us in a cycle of debt repayment. Break free from this habit, prioritize cash purchases, avoid unnecessary debt, and live within your means. Letting lifestyle inflation creep in. What do you do every time you get a raise or a bonus? Buy a bigger house or a flashier car? Studies show that nearly 78% of Americans live paycheck to paycheck, often due to lifestyle inflation. It completely erodes their savings and hampers any wealth-building effort, leaving them financially vulnerable. While some lifestyle improvement is not uncalled for instance, upgrading to a larger house if you are expecting your family to grow. But that same house can subtly yet dangerously derail your long-term financial goals if all you need is a 2-bedroom apartment. Resisting the temptation and prioritizing savings are crucial for achieving lasting financial security. Paying off only the minimum credit card balance. While mindlessly using your high-interest credit cards is bad, paying off only the minimum credit card balance is worse. Statistics reveal that nearly 40% of credit card users carry balances from month to month, often paying only the minimum required. This is one of the biggest reasons that U.S. credit card debt has surpassed $1 trillion. You need to know that the more you procrastinate, the more interest you end up paying when you could have easily avoided it. Following the debt avalanche method of paying off your debt ensures that all your high-interest debt vanishes in thin air, minimizing your interest burden. Not knowing saving is not enough. Have you got rid of the above bad habits, but are still not making the cut? That's because that's only half of the story, only one piece of the puzzle. Saving is only a crucial foundation for financial stability. It can only take you so far, but it will not generate intergenerational wealth. The richest person on earth, Elon Musk, also doesn't depend on one income. He has 4 giant companies: Tesla, Neuralink, SpaceX, and the Boring Company, and he still looks for more opportunities. You also need to consider ways of increasing your income in this high inflation economy. Whether it is investing or pursuing career advancement, every bit counts. Never asking for a raise. The world is not good for good people. If you think your boss will give you a hike just by looking at your work, you can't be more wrong. You need to know your worth. If you are valuable to your boss, he will happily give you a raise, but only if you ask. If you don't ask, he will continue to keep his costs as low as possible. But if you still don't think a salary hike is possible, you can ask him to give you a performance bonus. This way, every time you bring him better than expected results, he rewards you. This will incentivize you to perform better and bring your boss more profit, a win-win for everyone. Lending money to the wrong people. People can badmouth you for no reason and flag you as a shrewd, interest-hungry moneylender, but that shouldn't stop you from being cautious while lending money. Studies show that nearly 38% of people have lost money in unpaid debts. Therefore, it's crucial to avoid emotions clouding your judgment. Whether lending to friends or family, establish clear terms and prioritize repayment. You may or may not charge interest, but always ensure that they pay you back. After all, it's your hard-earned money, and seeing it never again as a financial habit you must get rid of at all costs. Overpaying taxes. Have you ever felt like a significant portion of your hard-earned income is disappearing into the void of taxes? But did you know that the poor, salaried individuals pay the biggest chunk of their income in taxes? Robert Kiyosaki mentioned in an interview that he and his good friend Donald Trump pay no taxes despite their billion-dollar incomes. But you who earn $10,000 a year pay as much as 20% of that tiny sum in taxes. Not fair? Stop focusing on the politics behind it and start finding out how these ultra-rich individuals can legally save their taxes. Not being aware of various tax deductions, credits, and strategies is a bad money habit. Educate yourself and optimize your tax situation. For example, maximizing your Roth IRA investment ensures your money grows tax-free. Waiting too long to invest. Have you ever hesitated to take the plunge into investing? It's too hard. I don't have enough money to invest. What if I lose all my money? Race through your mind. But each day you lose by not investing reduces the value of your money. Henry Youngman, a very famous American comedian, once humorously commented on the declining purchasing power of the dollar by saying, "Americans are getting stronger. 20 years ago, it took 2 people to carry $10 worth of groceries. Today, a 5-year-old can do it." Therefore, waiting too long to invest is a costly mistake. Remember, the best time to invest is now, and every dollar you invest today will compound over time. Start small, get financially educated, gradually increase your investment, and harness the power of compounding to build a secure financial future. Investing in things you don't understand. Just because everyone is investing in crypto, should you also invest in it? The answer is a big no. You are your own person with your own financial goals. Your rich friend can afford to lose a few $1,000,000 if the crypto bubble bursts, but you can't. You have bills to pay and loans to repay. So while investing does help you grow your wealth, first get educated about the risks the investments entail. If you can bear that risk, then only invest in that avenue. Even Warren Buffett avoided tech stocks except Apple because he didn't understand them. In his own words, Warren calls this circle of competence investing, which means only investing in assets you understand and which meet your personal financial goals. Putting money in get-rich-quick schemes. We have all heard the saying, Rome wasn't built in one day, but have you heard the saying, but it was destroyed in one day? Well, that's exactly how money works. It takes years to create wealth. There are no get-rich-quick schemes. It takes a lot of hard work. But if you are addicted to gambling, you will definitely destroy your wealth in just a day. The odds of winning a jackpot in Vegas or the Powerball lottery are negligible, and believing that it can work for you is the most convoluted way of thinking you could have.